All right. Good morning, everybody. So it's going to be a short holiday, not a surprise, right? A holiday week. But we still have increased levels of volatility. And I'm running things a little differently this morning. So if I could get some feedback, make sure the audio is good and you guys can see my screen. You should see Binance Juice. Awesome. Awesome. Thank you. All right. So over the weekend, I updated this weekend summary. There wasn't a whole lot to it. We had a doji week to end the week last week, and that leaves us on pause for how things shake out this week to go forward. So there wasn't a whole lot to update on the weekly perspective, but we do have, Wednesday, we do have the possibility of some slight fireworks. One of the things that I had wrote about over the weekend was this whole thing with China, and I always say, watch what they do, not what they say, because you'll have analysts and fund managers and everybody, they'll be out there chipping their teeth and they'll be on the news and everybody is so bearish, but their money's not. They're positioned long. And you got to watch the flows. And right now, China's the spot. I mean, everybody is piling into China looking for that reopening. And every wink and nod that even remotely suggests that China might back off of that COVID zero policy just fuels the flames for more money flowing into China. And then there was a couple of deaths over the weekend. And it looks like China is going to not bring back the COVID zero because they never have taken it away, but they're definitely restating their commitment to the zero COVID policy. And that is what sent us down this morning, but negligibly, right? I mean, we didn't crash and burn. It's just, it sets back. Everybody seems to agree at some point that China's going to reopen, but whether it's going to be, 18 months from now or 24 months from now, who knows? But that is a part of the reason that the market is down this morning. And we just want to continue to watch that, right? This is one of the reasons we say be very careful when you watch things like CNBC or, whatever TV out there. When you're watching those bobbing heads, they have an agenda. They are trying to sell you something. You are their product, right? You are their goal. They want eyeballs on their stuff, and they're going to say whatever they can say, whatever they need to say to get you to watch their programming. That's not necessarily helpful as traders, right? We don't want to position our accounts based on what we hear on NBC here, CNBC or whatever. Pick your poison. So the money flow is still solidly pointing to China, and long positioning for that alone is aggressive. But then we've got performance chasing, and we've got fear of missing out. A lot of the funds and firms who are running very restrictive policies didn't get to take advantage of the March 2020 rally when we came up out of those COVID lows like the phoenix out of a flame. And there's a lot of butthurt people that just didn't get it, but they don't want to miss it if we do it again. And so there's a lot of long positioning for an end of year Santa Claus rally this year. The threat, as I see it, is if that starts to unravel, it'll unravel very fast. There's a phrase in the market that discusses how it's really easy to find. If you're a buyer, it's really easy to find someone selling things, right? If you look at our advertising, it's almost all trying to sell you something. There's very little advertising out there that says, hi, I'm a buyer and I'm looking to buy this. If you have some of this, please bring it to me. There's very little advertising for that, right? Because as buyers, everywhere we look, there's somebody selling something. Well, that goes to the market as well. When the market is strongly moving higher and we want to buy to get in, there's still always somebody willing to sell to let you in. But when we're crashing and burning and falling from the sky, trying to find a buyer is a hard thing to do. And it's why markets fall faster than they rise. Because you have to really front run the selling to find somebody to get out, right? Someone willing to buy it. So with all this long positioning, if we were to start actually dropping significantly, it could turn into an epic flash crash, the likes of which we haven't seen in a couple of years since 2020. Markets can crash upwards too. I don't want you to think that I'm only looking down and saying the threat is to the downside. There's a threat to the upside. It wouldn't take much. Anything with the zero COVID policy in China, any strong definitive statement that says that's going away, oh boy, this market would explode to the upside. And anything that has to do with the war in Ukraine, if there is a statement coming out that in some way implies that there's an end in sight, this market would just run you over to the upside. It would be epic. So there is still a threat out there in both directions. Bob Iger is back from Walt Disney. I think that he might not be their white knight savior after all, but we'll see. That was the most dominant thing in the European market wrap, was the China possibly activating new lockdown measures and more worry about the rate hike, how steep we get to that restrictive territory. We do have a lot of Fed speakers this week. And speaking of Fed speakers, on November 30, Jerome Powell is going to be speaking. And it will be another Jackson Hole opportunity. I'm not going to, try to sell it as it's going to be, because I don't know. I don't think anybody knows. But there is the possibility for another dash of cold water, so to speak, right? Where he did that amazing mic drop moment in Jackson Hole. We'll see. Over the last week, they have been unwinding the 50 basis points and slowly focusing on 75 basis points, but it's been very slow. It's a minimal change, nothing drastic or extreme yet. So still a whole lot of maybe kind of sort of, and they don't know. And same thing on Bloomberg's 5 things you need to know. All right, we've got a lot of the front end of the curve this week with the additional auctions. 6-month, 3-month, 2-year, 5-year. No 11 o'clock auction, which I found to be a little odd, but it's all right. We got 11:30 and 1 o'clock. So for you 0-day traders, the afternoon session, get past that 5-year note first before you run, say, you know, a 0-day credit or a 0-day iron or something like that. I wanted to start today out here on the daily and look at the size of the box for the week. We mentioned it on Friday morning, but on Friday morning, the box is still alive. It's still moving, and it doesn't stop until the market closes on Friday. We can see how big the box is this week compared to how big it was last week. And it's important to recognize not only is it bigger, it has less days. That box is measuring 4 days, and they're not even full 4 days, right? They're half days in there. So for the entire week, we've got like a 3.5 day trading week. And yet they still gave the market more room to run volatility wise. The expected move is wider than it was with a 5 full day week from last week. That's how much volatility is in this week's marketplace. And that's a lot. And it should get your attention. It should cause you a little bit of concern. We are almost back to the center of the basketball court, back to 0. Everything starts from 0. From there, we could have a big move up or down, and the market would have plenty of room to run, right? When we're already on the edges, it's hard to see how we could make a 3 or a 4% move from the edges in the same direction. But when we're in the middle of the court, well, we can make big moves from either direction. And that's another reason why when I was writing my summary this weekend, it left so many unanswered questions. We're primed right now to go either way. And one of the smartest things that you can do is realize that we don't have the answer, right? And when we don't have the answer, just back up. Admit you don't have enough information yet to make an informed decision. Stand aside and wait for it. Instead, what I see a lot of people do is they'll just pick one and run with it as if there's some binary choice between we have to go up or we have to go down. Volume's a little light this morning, not enough to be concerning, but nearly light enough to be concerning. Sitting at 94, my benchmark for concern is right around 75 to 80. If it was less than 75 or 80, I would be concerned. So obviously we're kind of close to that. It's hard to say. I don't see anything in the market watch within this. The national activity index should not be that big of a deal. So I can't see that it's that one. I say that, but there have been times where even odd surveys that normally nobody would look at become the thing, right? So just note that the volume is light, and that light volume, generally speaking, implies that the market sees an event coming relatively soon, and they are willing to wait to participate until that event. And it's not normally a concern when we know what that event is, right? Say if this was Jobs Day or something like that. The concern this morning is we don't have an economic event on the agenda big enough to cause this kind of concern. So we're down 0.5% this morning. Our ADR is 2.2%. So we've got plenty of room to run. We've already tagged the daily pivot point, and we are underneath the weekly pivot point. This is the first time that we've been underneath the weekly pivot point for a while. Let's just back up a good 30 days. We'll turn this one off down here. We no longer need it. Oh, come on. There we go. All right. So the weekly pivot point was right there. And then right there. So we got above it like a week and a half ago. And we bounced off of it last week, but we're holding the line. We are definitively underneath it now. When we're underneath the weekly pivot point, we deem the market to be in a bearish market state. So we'd be looking for, short opportunities and short continuations, especially if we continue to move farther away from the weekly pivot point. We are also beneath one of my levels, the quarterly level. It's at 39.66. And then we have our cog lines. There is a cog now at 39.30. So we always talk about the 11s, 39.11, 40.11, 38.11, but there is a cog line at 39.30. It's certainly something to keep on your radar. We don't talk about that one enough. Friday was relatively narrow in the grand scheme of things. And that rally, yes, on Friday was awesome. That 3 o'clock rally felt really good about giving the heads up on that one. So this morning, we're looking for an inside day breakout, a test of yesterday's lows, and then a breakdown from that. Should we break down below yesterday's lows, we have the cog line at 39.31 or 30. The ADR half at 39.28. And then Thursday's lows at 39.11 cog line, which was also the previous week's lows at that 39.11 as well, right? So a lot of weight on that 39.11 cog line. We have a 50% retracement very close to 3,900 as well. That would be the benchmark from Thursday's really large candle, right? When we measure, large candles. I'm sure that looks pretty crazy, but here's the large candle. We want to mark 50% of that. So that's the downside move. For an upside play, we would have to get back through that quarterly level, 39.66, the Globex open 39.72, the weekly pivot point and the daily pivot point. Then our own Globex high, 39.81, the cash open from Friday, 39.90, and then a breakout of Friday's levels, 39.94. Should we get through all of that, we have the ADR half at 40.16, last week's high at 40.50, and then the ADR full at 40.60. Lots of pivots on either side because we've been sitting in this range, just building up more and more and more and more pivots. Playing along the edges of that curve is very likely going to be your best opportunity. Either a retest of the lows or a retest of the highs. I was looking at last Thanksgiving and the Friday after Thanksgiving. It was a significant move. But I went back 1 year before that one and it wasn't, right? It was a whole lot of nothing. So, you know, we have the capacity on that half day Friday to make some big moves, but I had heard a little bit of seasonality talk, and the impression that I got from that talk was, oh, after Thanksgiving, there's the potential for some shenanigans, either upside or downside, but big moves. And I mean, I didn't do, 20 years of research, but I looked back at the last two and it was hit one, miss one. So I'd say there's as much opportunity for shenanigans this Thanksgiving as there is on any other Thanksgiving. Need to be a little cautious this morning with the dollar. We got US dollar China coming up into that monthly level. It's a resistance that we rejected off of last week. If we take that rejection again this week, we're going to see the dollar make that move to the downside. That's going to give the market the clear path to continue to move to the upside. Should we break through this monthly level on US dollar China, there's nothing in the way for an extended period of time. On US dollar Japan, the benchmark is still that 145, and we're quite a ways underneath that. No major resistance levels of concern until we get to at least 144.5. So if from that perspective, there's nothing holding the dollar back. And if we continue to see the rise in the dollar, we're expected to see a continued weakness in the S&P and the NASDAQ. Same thing here with Euro US dollar. They're coming down into a monthly level of support. We rejected off of the quarterly level almost to the tick. And now we're working on that support level right above parity, forming a bit of a wedge. We have no major levels anywhere near us on the pound dollar. So we got the Bitcoin ETF down 3% this morning. The KWEB ETF down more than 2.5%. We've been using KWEB as a way to kind of monitor money flow into those China names. Emerging markets also down, not quite 1.5%, but pretty close to that. And emerging markets is a huge part made up with China names. And then gold, energy names from uranium, regular energy, oil and gas, crude, and then it starts to drop off after that. Metals and mining also, and gold is down this morning. So nearly across the board, right? Solar is not showing anything. And the regional banking, KRE, which I don't think KRE really gets flows. XLF is not down enough to hit our benchmark. Tesla is down more than 2% this morning. It might finally be beginning that breakdown. 165, I believe, is the target, that downside target on Tesla. $152, now 165. Looking at the gaps. We got one overhead at 186. We also had until Friday a gap at 177.59. That one got taken out finally, as it usually does, right? It usually gets back around to it. We're going to be opening this morning at 175. So we're opening down here. Now that old support is the resistance. So around 177, we're going to be looking for this to make a rally up into that resistance before continuing to move to the downside. If we were to use that big candle for our, measure the candle moment, give us something a little closer to lean on. 173 and then 169.5. That is a hard thing to see. Change that color. You can add 166 to that as well. Right, so plenty of targets to the downside for Tesla. Nvidia is down more than 2.5 this morning. It's kind of leaving us in this don't diddle in the middle range, right? It needs to break below, same as Tesla, it needs to break below the previous day's low and really begin to expand, or we're likely to find support and retest another run back up again. That's the kind of situation that we're sitting in. On this bigger time frame here on the weekly, if we consider this our range, then we're not at the top and we're not at the bottom. Leaves us in that precarious spot. Notice the trend line underneath is still there, right? That lowered trend line, it's still valid. We haven't broke below it this morning. That would be around 142 area. So until it breaks below that, Nvidia has the capacity to still run back up again. Qualcomm is out of the channel that it developed last week. $119 would be my target if we continue to fade this morning. Got a little bit of support around 120. Then the target would be 119. So 120.75 and then 119. So we had this channel on Google for a while, and we still have it. Nothing got resolved Friday. This morning, we're sitting at around $96. So we're outside of this. The support didn't hold. Just keep in mind that until the end of the day today, as long as the market is still open, this low has not been validly broken yet, right? It needs to break and close below on the day outside of that channel. Otherwise, it could just wick down there today and then rally back up and close inside the box again. If we do close outside the box today, which seems, right now a distinct possibility, then we'll focus on working our way back down through the support levels with 92.25 as our targeted concern. There is a gap down here. This is a red candle that is hollow, which means we closed here, we opened here, rallied up and closed higher than we opened, but we closed lower than we closed the day before. So that's 95.7, which is $1 more lower than we are right now. Google should be able to easily hit that. The concern is that would be a great spot to bounce and then run higher. It would close that gap, which a market wants to do, and then it could be the rebound to get us back inside the channel again. Another one with Amazon, kind of diddle in the middle situation again. That's our candle of control between 105 and 88. Yeah, these others aren't as good. Try quarterly level. So of course we do have that really big gap, but it's way too far away for our concern on today. And then we have this gap down here where we closed there and we opened here. So this morning we are above that for the moment. And we're going to be looking to see if it's going to come down into that channel. $86 would be the bottom. That would close the gap. Getting into the channel would be 92, 90. Well, we'll just call it 93. Now, as I mentioned before, a lot of analysts will target anything on that candle. So it's worth marking where the open is, and that would be 89.5. If we continue this weakness this morning, once we break below 92, 89.5 becomes the target, which isn't bad. I mean, that'd be a nice day trade or even a short duration trade. The thing is, we're bearish this morning, but it's not heavy. For those of you who don't use it yet, I normally re-up my TradingView account on Black Fridays. I found that's the cheapest time of year to do it. But I had a client around like March or April a few years ago who said, well, they didn't want to wait. And they actually pulled off this neat trick. They used the trial version of TradingView, and then when that trial ended, they let their subscription end there. And after a week or 2 weeks, they got emails from TradingView offering them a better discount than what I got on Black Friday if they were to come back and sign up. So if you don't get Black Friday now, when it's offered, and say later on you want it, after all the holiday seasons or whatever, try that little tactic, because it worked out better discount wise. They got better than what I got. The reason I use TrendSpider and TradingView and these other ones is when Thinkorswim was being sold to Schwab, there was periods of time where you really couldn't trust Thinkorswim was going to function every day, right? There was down days, it was glitchy sometimes, and I needed a backup place to do analysis. I needed to know that, hey, if everything goes down on Thinkorswim, I can still trade and analyze the market. So this became my backup. You can also use your trading account, say your futures account over here. So for those of you who don't like Trade-of-8's platform, you can trade here, but you don't have all the flow tools that you do on Trade-of-8. $39.08 in the S&P is still a significant level of concern. Definitely want to keep your eyes on 39.08. When we were coming up off of those lows back in the early part of October, 39.08 was my first target to the upside. Then we stalled. We'd never made it to target 2, came back to target 1 and tested that old resistance as a support level, got a Busby off of it. With that Busby, it only owes us back to the cog line at 40.11. And of course, with the market down this morning, we're going to be opening gapped down. %42 of the S&P is down this morning, at least 0.5%. And when it comes to the S&P, there's no financials in the NASDAQ 100. So when we're looking at the S&P, we want to focus first on the financials. I see a lot of chip names in there too. But there's our Bank of America, Capital One, MasterCard. Those aren't really the financials I'm looking for, though. I'd be more interested in JP Morgan, Wells Fargo, and Bank of America. So just seeing one of those in the group kind of makes me look around for the rest. Lots of energy names in there this morning. Some chip names and a little bit of retail. Flip it over to the NASDAQ 100. We have 47% of the NASDAQ 100 down at least 0.5%. The monsters of tech stand out very solid. I see some automotive names in there. Those China names that we focus on, Baidu, PDD. I don't see it yet, but I'll bet Boeing, or not Boeing, but Baba's in there. See if we can spot that bugger. Netflix has been a great short. Let's go back to Netflix for a minute. So Netflix on the monthly, we're still inside this really big candle, 305 to 211. And looking at the bid ask, we're barely down like 20 cents. We now have a gap to contend with from last week. And if that 280, we'll just call it 288. If 288 breaks this morning, we've got a clear shot down to 275. Should be able to make that move relatively quick. All right, so we got a lot of names in this pivotal moment. It's going to be a lot of the dollar today. We got the dollar needs to get back above that 108 level if we're going to continue to see the S&P move to the downside. If that dollar backs off or fails to continue to run this morning, even a pause in the dollar is all it would take. The dollar won't necessarily have to fall down. It will just have to stop advancing. The good thing is the dollar opens early and bonds open early, so you get a little bit of a heads up on the day. with what to expect. You can see the bonds making a little bit of an aggressive reaction here at the open. But in the big picture, the bonds have been really, really beat down. For years and years, we've been on this path, and it's broken now, right? Like, I'm not even back far enough on stockcharts.com. You can go back even farther than this. And there is a critical level that was broke. It'll take years to fix this. So a lot of talk is that we're not done in the drop in bonds, that it is not yet performing a bottoming formation, and that this is just a pause before going lower. That's a really big picture that we don't need to be concerned with for the morning briefing necessarily. Other than to say, this morning, if we do start to see yields come off and the dollar come off, then we can see stocks and bonds making that rally back up, right? That it'll be the S&P and the 30-year likely making that move. Out of the four indexes, the S&P, the NASDAQ, and the Russell are all underneath that 3-period daily exponential moving average. Only the Dow is above it, and it just got above it this morning. So it needs to stick before we would count it solid. But the Dow is leading the way this morning. It's very likely because of Disney. And we would never say that in a different index, but the Dow is different than the S&P and the NASDAQ. One is price weight and one is market cap weight. So the Dow can be bullied by names like Disney or Walgreens, whereas names like that would never be able to push around the S&P or the NASDAQ. So it's very likely that the Dow is leading only because of Disney, or maybe some healthcare names, but healthcare wasn't really standing out when we were looking at TradingView this morning. So here we got the S&P 500 filtered down to just about 100 names. Looking at it from the pre-market point of view, Disney stands out with a 9.5% move. Everything else that's green is barely green, right? Verizon, Coke, Eli Lilly, and Boeing, but they're a minor green level, right? Tesla 2% to the downside, Nvidia 1% to the downside, and then the rest of them spread out between Microsoft, Google, Apple, not even 1% yet. So it's all about the dollar. Keep your eye on that thing this morning. The VIX is continuing to improve. I was checking out the CBOE website over the weekend, and it is still a concern. A lot of places are focused on it, but they still don't have an answer yet for what they're going to do about it. We know what the problem is. We don't necessarily know how we're going to fix it. So looking here at the VIX, you can see we're at some pretty low levels, all things considered, but only in relation to everything that's happened since COVID, right? If you go back farther than that and look pre-COVID, we're still in a high volatility market environment. We would need to get down, somewhere below 17, 16, and even then, it would still be high compared to what it used to be. This has a lot of impact on everything. Our weekly iron condors, our, double diagonal plays, everything. I was using options Omega on the weekend and was back testing a 60-day iron condor with some really great results. And I went back 2 years. That way I could have the violence of this year and then the low volatility environment, or lower volatility of last year. All right, for nat gas, if that lower trend line holds, we could be looking at, a nice rebound to finish the year off with nat gas higher. I don't think we're going to be able to make it above, say, 35 for the year. But if we can maintain inside of this box, it certainly offers, opportunities for credit spreads and things like that. This candle is the controlling candle. So as long as we're maintaining inside of that, and nat gas is up this morning around 20 cents or so, not a massive amount. So on nat gas, we're going to be looking for that breakout from Thursday's level. First, we have an inside day breakout for Friday. Then we get through Thursday. That is $21, kind of smooth sailing above that. I see a lot of tech names, but the illiquid tech names, right? Names that just don't have the liquidity to be great opportunities. All right, everybody, keep in mind this week that it's a short week. That's going to mess with your optionality. While the futures market will be opened back up Thursday night and into Friday, it'll be a short day Friday. And short days in the futures are always a little dangerous. Could be, perhaps just proceed with caution, right? Wednesday is still going to be a game changer. Everything is likely to hinge on what happens Wednesday for the S&P and everything else. And remember what I said as we started today, that the analysis that I was looking to perform over the weekend was really heavily dependent on the idea that we had a doji as we went into the close last week, right? So decision time, how we open in today is going to be a big deal, and I'll write about it this evening. So opening today and then Wednesday. That's what I got for you guys. Be careful.